Hello everyone. In this volatile market, all the investors are looking for an investment solution. And there's a lot of buzz around this new category, which is income plus arbitrage category. And we have Mr. Devang Shah, Head of Fixed Income with us to talk about this. So Devang, can you give investors some perspective on what this category is all about?
Thanks, Shika. The income plus arbitrage FOF category is a category wherein up to 65% of its investments are in underlying debt funds and the balance 35% is in arbitrage funds. It is important to understand that there are certain categories as per taxation rules, which is one where it is a specified mutual fund category wherein more than 65% at all point of time is invested in debt and money market funds. There's a second category which is equity mutual funds, wherein a large percent of allocation always is an equity fund. The third category, which is not an equity and not a debt fund, is this category wherein between 35 to 65% you need to hold equity. In simple terms, up to 65% has to be in debt and the balance has to be in arbitrage funds or equity funds. So this category makes a lot of sense for investors because the tax incidents are different. If you look across at in the category which you're talking about, the tax incidence for an investment horizon of 2 years is 12.5% as compared to debt funds, which is where it is very higher. So as per me, I think this category makes a lot of sense for investors who are looking at low volatility as you specified in this uncertain time and looking for tax optimal solutions.
So Devang, since this is a new category, but can you give us an understanding that historically how this category would have done in different market scenario?
So as you rightly highlighted, Shekha, that this is a new category and we don't have any data which is somewhere down the line good enough to our past performance to demonstrate how this category has worked well. What we have tried to work along is, and it is there on your screen now, is that we have tried to run across a simulation and it shows about a trend of 20 years, last 20 years, and in various market environment and market cycles. This category actually comes out to be a solution which offers low volatility and a better tax optimal solution for an investment holding period for more than 2 years.
So if now I come down to your fund, which is Axis Income Plus Arbitrage Fund of Fund, what is your thought process around it and how are you managing it?
So if you're asking me how are we running the fund at Axis and how is this fund different from markets? So first of all, the important aspect is that we are focusing on the quality buyers. So at all point of time, the underlying funds which we select in would have a larger proportion towards 100% AAA oriented corporate bonds or sovereign bonds. Second important element is that the fund will be running the strategy dynamically. So depending on our market environment, depending on market conditions, the fund will choose be it your interest rate views or interest rate duration funds, be it credit funds, or at particular point of time, we will be holding a lot of cash oriented strategies. Thirdly, I think the most important differentiator as against markets, I think is an important element of that we are running a multi-fund house strategy versus a single fund house strategy. Why multi-fund house strategy? I think it helps significantly to provide better investor solutions and returns over different cycles. The other features are at the current juncture, the fund is running a 0.06 basis of direct expense, around 45 basis on regular. It has a nil exit load and the redemption cycle is a T+2.
Okay. Devang, you mentioned you have opted for a multi-fund house strategy. So is there an added advantage of doing a multi-house compared to having your own single house fund?
So we believe that multi-fund house strategy is of significant benefit. I think there are two distinct disadvantages which an investor gets while investing in a multi-fund house strategy. The first is when in an adverse credit environment, multi-fund house strategy helps you to significantly diversify your holdings and the impact of a credit event or a downgrade is significantly less. The other main advantage of investing in a multi-fund house strategy is that you remove the fund manager bias and his investment style bias. So that helps over different cycles to generate better returns for investors. So I think a multi-fund house strategy is far much better than a single fund house strategy.
So Devang, 2 points, I think 2-point questions from my end. One, when you go for a multi-fund house strategy, what is your criteria of selecting a fund? And also, you mentioned that you will dynamically manage the duration. So, how are you gonna, change that view with the multi-fund houses?
So, Shika, if I look across at the two questions, first important is what are the selection criteria for while you're selecting any funds.
Right.
It is like any investor chooses, okay, a fund. We'll be focusing on the EUM of the fund, the TR of the fund, the entry exit load for the fund, and at all point of time, how stable has been the performance over various time frames. These are more important the selection criteria. But we'll also restrict ourselves at all point of times in the top 10 debt fund houses while investing in these funds. Secondly, I think there are internal guardrails and guidelines which we have put across to ensure that there are thresholds for single scheme limits, there are thresholds for a fund house level. So we have put across all those limits in place. Now coming across is how we are running the fund in this market environment. We have been remained bullish for now almost last 15 odd months, where we have been running long duration strategies across all our portfolios. So this fund also, an FOF fund also, will have a higher allocation towards, or if you look at the last 12 months, they will be having a higher allocation towards long duration funds. What we believe is in today's market environment, RBI will be looking at probably supporting growth, and there will be further rate cuts. So at this point of time, the fund has an allocation toward government bonds. But we've also seen a change in stance from RBI on liquidity, where they have infused more than 10 lakh crores of liquidity, and that will lead to the short end of the curve also performing very well. So what we have tried to do across at this point of time is balance our allocations towards government bonds and 3 to 5 year corporate bonds, which we believe would be the best strategy. So accordingly, we have chosen long bond funds and corporate bond funds in this strategy while investing.
So Devang, you mentioned a couple of guardrails there, like single AMC exposure limits. So are you also thinking around how do you maintain your high quality biasness into it? Is there any coverage of other funds which are investing in your controlling, because you don't have control on other fund houses?
That's a good question, Shikha, because generally investors are worried about that how will you manage the credit risk in an environment where there is a significant deterioration in the credit side. We believe that first, we will be restricting ourselves to the top 10 debt AMCs. Secondly, at all point of times, while selection criteria, we will also look at the underlying portfolios and ensure that a large part of the underlying holdings of those funds replicate our credit universe. So that's the way we are going to manage and ensure that in an event where there is a credit downgrade or a default, the impact to the client is significantly less.
I think, Devang, you're well positioned the fund. You are diversifying the credit risk. You're taking the duration calls there. Can you sum up this a bit for our investors?
So, if you ask me, I think the first important message from our side would be that the fund is a very good tax optimal solution for investors who are looking at low volatility and somewhere down the line an option or solution at this point of time in uncertain environment. The second important aspect is that at Axis, we are running this fund dynamically with a multi-fund house strategy. We will be focusing on our investment thesis where, basis our market view and the current market environment, we'll be choosing the funds and we'll be allocating across various strategies. Today, currently in this environment where we are anticipating rate cuts, we are running a slightly higher, longer duration. But once the rate cycle is over, we'll be maneuvering our duration to a lower duration bucket and move a large part of our allocation to corporate bond funds. So that is our 3 key takes away from my side.
Thank you, Devang. That was very insightful, and thank you everyone for watching the video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.